Away we go. Well, hello, everybody, and welcome to the BAP webinar. Now, some of you may not be familiar with what BAP is, and BAP is a great group here in Austin. It's called the Business Advisory Professionals. And BAP, all of our members are engaged in their specialized areas, helping executives run their businesses better. Now, this is a peer group of people from a variety of different industries, and we have all come together to be able to serve our clients better through having an amazing network and great accountability. So if you need any type of service in the greater Austin area, gosh, or beyond, because so many people do business all over the country and the world, you want to make sure that you're familiar with BAP, whether it's your finances, whether it's real estate needs, whether it's banking, whether it's executive search, across the board, bookkeeping. You need to talk to the people at BAP. So check us out at businessadvisoryprofessionals.com. And yes, I know that's a lot of letters that you have to type, but businessadvisoryprofessionals.com, and you're going to find out everything you need to know at BAP. In days that were pre-COVID, every single quarter, we hosted an informative and yet fun happy hour where we would have speakers come in and talk about different areas that would help you run your business and be successful. Sadly, in the last 7 months, we haven't been able to gather in person. So we've started doing our BAPinars, or the webinars that are put on by members of BAP and other people in our community who can come and share the best pieces of information that are going to help you thrive through this crazy time of COVID and beyond. Because let's face it, the one thing I know from my research is every pandemic we ever have had in over 1,000 years has had one thing in common. It eventually ended. And when that day comes, we will be able to come together, and BAP looks forward to having more of those happy hours. But in the meantime, every quarter or every couple months, we've been doing these webinars, and today's is going to be awesome. So today's, we have 3 people who are going to talk about 3 ways to move forward in this challenging business environment. And we all know that this is a challenging business environment. So I want to jump right into this. You don't want to hear me talk much anymore, but really quick, just for the standpoint of introduction, my name is Tom Singer, and I work for a company called Stanton Chase International. It's an executive search firm. I'm also a professional speaker and master of ceremonies. I do these type of Zoom meetings day in and day out with different types of associations and companies all around. We're also joined by Stephanie Emory from Edward Jones. We are joined by Greg Gaynor from Echelon Financial Group and Lindsay Connor from TMV Business Group. Each of them, and I'll introduce them each individually when we get started, each of them have so much great information to share with you. So if you need to contact any of them, for Stephanie and Lindsay, you can find their information on the BAP website, and Greg is going to share his information during his presentation today. Couple things. Please, I encourage you to use the chat box that is here in this Zoom webinar thing. If there's anything that you hear that you like and you think is awesome, here's a little secret. You know how you applaud in chat? You use the exclamation point. So if you want to say, yay, that's awesome, just give a couple of exclamation points, and then we can see that go by. You also can share with each other something that someone says that you're like, oh my God, that is awesome. However, if you want to ask questions of any of the speakers, and each one has time for Q&A allotted at the very end of their talk, and then we'll do a bunch of Q&A at the very end. If you want to ask questions, please, to make my life as the moderator easier, please use the Q&A box, because it's easier for me to follow, because I expect so many applause going on in the chat room with all those exclamation points. We'll never be able to find your questions back in the thing. So I think you're all ready, and I know I'm ready to get started. So first off, we have Stephanie Emory. And Stephanie, she shifted from an operations management career, but she took those skills and she now uses that to help her clients as a financial advisor with Edward Jones. She is here today to provide a high-level economic update that is going to help you make better strategic decisions. So at this point, I'm going to hand it over to Stephanie.
All right. Thank you very much, Tom, for the great introduction. So here I am actually talking to y'all from my office in South Austin. So the place from where I love helping my clients have peace and confidence in their financial plans. And yeah, as Tom mentioned, it is shocking to think it has been actually 7 months since I have had the pleasure of having a client sit across my desk from me and talk in person. It has been a little bit like Groundhog Day for me. for 7 months, and I imagine I'm not the only one feeling that way at this point. So a little bit about y'all. I am interested to know if your interest today in Economic Update has to do more with concerns for your businesses or your personal portfolio, or both. So you could use the chat feature and just say business, personal, or both, just out of curiosity. And thank you for that. And now, so on to navigating these turbulent waters. So if we can think of 2020 as a river that is flowing, it is actually full of white water. And so my goal for us today to share with you is actually to take a step back, to look from above at this river and to help you see where some of the rocks and some of the debris are, so that you can maybe make some better decisions then as we move forward down this river. And from where we are now then, in the year, we can clearly see that COVID-19 has been a catalyst for a lot of tech adoption. And with that, we see its impact on consumers. Consumers have been doing a lot more online shopping. They have been working from home a lot, and also getting very familiar with using video conferencing. And then in companies, that tech adoption takes the form of changing the way they operate, helping them incorporate tech to boost their productivity and their profitability and reduce costs. So what that means, what we expect to see then, the lasting impacts of COVID-19 is that there's going to be an ongoing increase in demand for online shopping, digital payments, telemedicine, for cloud computing, and also for video conferencing. And with these changes too, we can see the ripple effect, how it's going to impact, say, commercial real estate. Expectations are that the demand for office space may fall off. And on the other side, then there may be a pickup of need for warehouse space and also logistics space. And a further ripple then into housing markets, we may see an increase in demand for homes in the suburbs rather than city living. So that's where it's brought us so far. The pandemic, meanwhile, has also exposed some vulnerabilities, both in the supply chain and also the flow of goods. And impacts from that could mean that more manufacturing is going to return to the United States. And then with that, and also in response to the pandemic, there could be more business investment in automation. So this, of course, will take time to evolve. And so here we are now. The third quarter has just ended for the year. It has been an economic year unlike many others. So the second quarter is actually when we saw the economic data come through for most of the downturn. That's when we saw the pain reflected in the numbers because of the timing of the shutdowns. Now, the third quarter, for some sectors in the economy, has actually shown us a rebound in those places. Now, if we want to get back, one day we will get back to pre-pandemic levels, but it is going to take time. We know it's contingent on having a safe vaccine that is widely available. So until that happens, any further recovery is going to be slow. It will stretch throughout the fourth quarter and well into 2021. Again, dependent on timing of a vaccine. But one sector in particular that we saw a strong rebound in the third quarter was for retail sales. And they are actually back near their 2019 levels at this point. However, the big unknown is if consumers are going to be able to continue buying absent any further federal aid, which is another big topic, which I'm only lightly going to touch on. What is going on with federal aid? What's going on in Capitol Hill? The only thing that that we could comment on right now is it does seem universal, the agreement that households and small businesses do need aid. But we know that there's a lot of political maneuvering going on, and there are a lot of disputes over the size and the scope of that aid. And so it's going to take more time. And we will all find out what that means. But yeah, the overall impact on what's going to happen in the fourth quarter with consumers is to be determined, and beyond into 2021. Now, fortunately, we all did benefit from the monetary aid that came from the actions of the Federal Reserve earlier this year. So we know that they reduced interest rates. We're feeling it in our personal savings accounts, but also in lending. So fortunately, the low rates on lending have been a lifeline to businesses that are struggling, both with lower demand and declining earnings. And we do expect that these lower rates are going to stay low at least through 2021, if not another year or two beyond that, but of course it's too early to say for sure. But a side note on that is to realize that companies already had record levels of debt that they had taken on leading into 2020. And that was because there already were low interest rates and they had taken advantage of that. So we'll have to just see what the impact is as some companies are not able to make those debt repayments into the future. So that's another challenge to keep an eye on. And so now what I want to share further about interest rate actually is more for the personal portfolio side. So thinking about return on bonds. Bond returns are at record low amounts. The annual yield on a 10-year bond has been fluctuating between 0.6 to 0.9%. With that said, it is still very important to keep a diversified portfolio. It is important to have a mix of assets. Owning bonds in your portfolio is a way to help buffer when the stock markets go down. So in order to increase the chances of you having positive returns in your portfolio, let me just reiterate one more time, diversification is critical. Stocks and bonds are important, even when it's challenging to stay patient, when it doesn't seem to make sense. And also when it comes to your portfolios, the idea of staying invested is also very important, especially when the market goes down like it did in March. And not that we expect to see, as a result of COVID, market declines as dramatic as we did in March, but we know that the stock market doesn't go up forever. It doesn't go to the sky. And so when there is volatility, we need to stay invested when things go down. And the other side to that is also do not chase returns when choosing your investments. What we don't want to do is to buy the next big hot thing that's in the news and to pay a high price for it because everybody's excited. So we do not, when we invest, we do not want to buy high. And then when we get nervous when things go down, we do not want to sell low. So as we move forward, we are expecting volatility, definitely in elevated amounts through the end of this year, through the pandemic. And so just keep in mind then, when that happens, when the market goes down, we're experiencing that, that is a great chance to go ahead and buy low, to take advantage of that opportunity to buy great investments at a low price and to further diversify your portfolios. So in closing, I hope that you've heard some things both for business and for personal here and what I've had to share. And I want to encourage you then to continue to focus on the things that you can control, to keep your eye on the big picture goals that you have and to take advantage of opportunities as they arise. So Thank you for your time. And Tom, yeah, if you could give me a hand if there are any questions then.
So, I actually had a question because you talked about the fact about interest rates being sort of low and all that, but something I don't have the background that you do. I heard that interest rates can actually go lower. And somebody told me the other day that they could actually go negative. I don't even understand how that works. And if that happens, how does that impact all of us?
Yeah, that's a great question, and one that I hear often. So typically we hear that the monetary policies in Europe, they have explored the idea of going negative. And the goal behind it is to make it so unappealing to leave money sitting in the bank that people are going to find ways then to put their money to work, to be investing in companies. But there is actually very little evidence that using those negative rates have helped further their goals of economic expansion. In fact, keeping it closer to home, then some other things that the Fed has done for us, other stimulus measures such as purchasing assets, so buying bonds, that has actually been more effective. Buying the debt of companies, in other words, has been a more effective way for the Fed to help us. So Tom, we're not going to get in the weeds of what does it really mean and how does it go negative, because it is very, very unlikely to happen here in the US, but I'm glad that you asked.
So one other question that came in was about the election, and
Yes.
you sort of skimmed on the election thing, but
Just barely.
how is the election going to impact the markets?
Well, I wish I had a crystal ball.
Come on, Stephanie.
Doesn't everybody? So again, something else that is on a lot of people's minds. And looking back in history, there is very little evidence to support that the market is going to go one way or another. But there is a trend that we can recognize, and that is that when an incumbent is reelected, that generally the stock market does a little bit better, and we believe that that's tied to the fact that there is policy continuity. Now, with that said, 2020 and the pandemic and the economic stresses that we're experiencing are very unusual, and we don't expect that typical trends will continue, but we don't know. We don't know. However, I do want to take the opportunity to point out that we don't think that politics are a long-term driver of the market. When we look back over the last 30 years, we see that markets on average have grown approximately 10% each year on average. And that is regardless of who has been in the White House, who's in power in Congress. Mm-hmm. It is based on companies and what they are doing primarily. So anyway.
So one more question just came in, and that one is from Susan. And she said, if the bond rates are so low right now, mm-hmm. if we purchase bonds at this rate, will the return change if the market changes? If you purchase them now and things change, will the rate on that bond change?
So if you were to buy and great question. I'll see if I can make it short because there's a lot of variables there. But if you're to buy an individual bond and we know what rate it's paying, that bond will continue to pay that same rate until it matures in general. However, so what will impact, if you wanted to sell the bond early before it matured, what would impact how much money you could get back for the bond, or even if you have that bond listed on an investment account statement, which would show an expectation of if you were to sell it early, what would you get? What will impact that is not the movement of the stock market, but of the rates, the interest rates offered by the Fed. And so yes, if rates go up on new bonds, if you were to try to sell your old bond at a low rate, you wouldn't get as much money for it. Anyway, so it works opposite. But Susan, definitely if you want some more advice relevant to your particular situation, please contact me after this.
Awesome. Well, Stephanie, thank you so much for sharing with us today. And we'll bring you back at the end if anybody has any additional questions for you. So,
okay, great. Thank you all.
Next up, we have Greg Gainier. And Greg is a seasoned retirement plan specialist who helps employers design and create and manage their retirement plans. And he has over 28 years experience where he has seen hundreds and hundreds of employers do it right and many who have done it wrong. You don't want to make mistakes when you do that. So today he's going to talk to us a little bit about sort of how to help your employers attain financial security and ways the company can do that in the right way. So Greg, it's all yours.
Whoops.
I think you're good. You got
Sorry
it?
about that.
That's all right. It's all yours. Go ahead, Greg.
Hi, everyone. I want to thank Stephanie for a very informative presentation, and of course, Tom for leading us. I'm going to start here today by asking a simple question. Are you a plan sponsor? Do you sponsor a 401k plan? Are you an employer in that position? The reason is that right now it's challenging. COVID is wreaking havoc with employers and also with employees' decision making. But what we're going to focus on are ways to strengthen the plan and ways for you as the plan sponsor to guide your plan as we come out of it. Because as Tom said, we will eventually. And my strategy is always to aim at the future and try and improve what we can do now so that we get better outcomes. Now, when I talk to plan sponsors, I always ask them, what's really the most important thing? What are you focused on? And typically they'll say something like, well, you know, I'm focused on plan fees, or I'm focused on investment returns. From my perspective, that's a mistake. The reason is, and I want you to think about why you sponsored the plan. The purpose of the plan is to recruit, reward, and retain your most valuable asset, your employees. And basically, your focus should be on how your plan is doing at those three things. Now, what's the most accurate indicator? It's your participation rate. And right now, companies' plan participation is under pressure because of the things going on in the economy and how it's impacting firms and people's concerns with unemployment. But as the plan sponsor, you want to keep people contributing to the plan because everyone needs to save for retirement and everyone needs to invest a portion of their income for their future. Now, this may sound challenging, but your goal really should be 100% participation. If your participation rate is lower than that, it usually indicates a problem with employee engagement. If your purpose is to keep those people happy, the people who aren't contributing may be the people who are going to walk out the door or leave you in the very near future. Now, is 100% participation possible? Yes. We see plans do it all the time. If your plan currently has participation of 80% or something like that, you have a problem. You're going to have higher turnover. So we ask the plan sponsor to focus and to execute a strategy designed to keep those participation rates up, to keep contribution rates improving. Now, the second reason for that, and I apologize here, I had that covered up. The second mistake that people make is not focusing on the actual contribution rates. You can't change what happened in 2019 or 2020. Your focus needs to be on the future. A healthy plan has healthy contribution rates. And basically, in this case, I'm talking about three basic contribution rates. The first is your overall average. The second would be the contribution rate of a highly compensated group of employees. And then the third would be the contribution rate of your non-highlies. But let's look at this a little bit closer. Every business has employees that drive the results. I'll call them key employees. Typically, they tend to be a little bit higher paid, and they're very much tax motivated. They want to contribute a significant amount to their retirement plan to reduce their taxes. Now, the rules, which are set up by the IRS, pose a challenge, and it's called non-discrimination testing. And I'm going to try and make something that's a little bit complex very simple. Basically, we're going to divide your employees into two groups by income. For this particular year, it's based on 2019. Or what I'm saying, to say it slightly differently, your decision or which group an employee lands in is based on their compensation from last year. That affects the test or sets the subsets. The first one is highly compensated employees. That's people who earn more than $125,000 last year, and non-highly compensated employees. Those are people who earn $1 less. Now what happens is after the plan year ends, a calculation is done. A test is required by the rules the IRS has set. And any highly compensated employee is limited in terms of their contribution amount to no more than 2% higher than the average of the non-highlies. Now, frequently, I talk to plan sponsors and they'll tell me, why do I have this plan? The people I'm trying to reward, recruit, and retain can't contribute what they want. Well, the solution is to change your focus and try and make sure the contribution rates of that non-highly compensated group. The reason is that your highly compensated will complain. If they get a refund, it happens in March. They get a new 1099, they end up paying higher taxes. They don't like that. Well, if your focus is trying to keep that person happy, you could adopt a safe harbor contribution. Although currently with the distress we're under, the challenge that many employers are facing is they're talking about, well, I may have to reduce that. I may have to stop that. I may have to change that. Well, the way to succeed long-term, because we will come out of this, is to focus your energies and develop strategies to increase the contributions of your non-highly compensated employees. Long-term, you should set a goal. Now, up on the screen, I'm showing 12%, and I've had people tell me that's impossible, but yet I have employers who've achieved that level of contribution rates. I've had employers where they have extremely low employees, low paid employees, basically, people earning $2 or $3 more than the minimum wage. It's still possible to get those people to contribute. It's still possible to get them to raise their contribution over time, because of the simple reason that they need to retire. To do so, you need a strategy that focuses on nudging that participant to a higher contribution rate, rewarding them if they do it with employer contributions, and educating them about how it will work and how things will improve for them. Now, sorry. Let's go to our third mistake. This is something I see all the time. Approximately 3 weeks ago, I visited with a prospective client for the first time. And that client was complaining to me in the meeting. It's the first thing he said wrong. He mentioned that he was asking the question, well, why do we even have this 401k plan? We have terrible participation. We have very low contribution rates. And I continued to ask him questions about it. And I asked them, well, how many investment options do you have? And he said, well, the executives told me that they wanted a lot of choices. So we have 68 investment options in our plan. I stopped for a minute and said, well, don't you think that might be confusing to your lower paid employees? Don't you think that might be confusing to people? Now, the rationale for this is behavioral finance, and behavioral finance proves over and over again that if you have too many choices, what frequently happens is that no choice at all is made, that people avoid making a choice by not participating or not contributing. So if your plan has too many investment options available in it, that may be the cause of low participation or lower contribution rates. Now, I can tell you that in the very large plan market, this is being targeted by the plaintiffs bar. Basically, they look for plans with a large number of investment options and they take them to task over it. And the argument is, are they actually selecting and monitoring the investments? The best guidance I can give is that every situation is a little bit different. If you have a lot of sophisticated employees, you should have more. If you have a large amount of non-investment sophisticated employees or people who don't have college degrees, you definitely want to go less. Now, some simple guidelines. I want you to think about employee behavior here. What employees do, somewhere between about 70 and 90% of participants really don't want to make the investment decision. They want somebody to do it for them. So in an ideal world, you would have one investment option that's designed to handle different employee situations. Frequently, that's something called a target date fund, which may be 9 or 11 funds with specific vintages or times in the future that they manage risk to. Or you could have a suite of target risk funds. But the point is, you don't want to have 2 target date funds or 2 target date funds and 2 risk-based funds. A risk-based fund takes a slightly different approach, but if you have a good target date fund or a good risk-based suite, you're in the right spot. You're simplifying the decision and you're helping that employee doing it for that employee by giving them professional management and taking them out of the investment decision. Now, about somewhere between 10 and 30% of your employee population wants to make those decisions. They want to have a say in their investment options. And you can build a terrifically diversified portfolio with 18 or less additional investment options. Now, to give guidance, your typical very large plan, like a Dell, they will only have 10 investment options because they're entirely focused on eliminating the confusion. Now, less is more, and usually if you have fewer choices, you end up with better results. Now, the IRS and the Labor Department, who are the 2 regulators of retirement plans, like to come up with words that are nonsensical. I'm really kind of a qualified plan dork investment advisor or geek. So I could use those initials too. But anyway, what is a QDIA? It's a qualified default investment account. Now, I mentioned that prospect that I was talking to approximately 3 weeks ago. And one of the things I asked them is, do you have a default investment option? And he said, yes. And it was one particular fund. And I followed up that line of questioning and I asked, well, is it a qualified default investment account? He looked like I was speaking a foreign language. He said, what the heck is that? Well, a QDIA is a very sound investment decision made by the fiduciaries. It provides enhanced protection for the fiduciaries for any liability that they might have for default. Now, I mentioned that prospect, when you select a default and you don't do it in a manner and actually name it as a qualified default investment account, you don't get that fiduciary protection. Now, the key element is you have to have a process, and you have to go through that process and select the investment options and document why you did, and then periodically monitor that decision in case you need to change it or find a new QDIA. Now, the reality is, I mentioned confusion before. A QDIA usually helps eliminate some of the confusion. And here's why. You're going to the participants and you're explaining to them and saying, this is the investment option that we're going to use to default any participants who don't want to make an investment decision. Well, what does that participant hear? Oh, that's the one they checked out. Maybe I should just do that. And what I'm doing is helping the participant with the most challenging decision by giving them one that's been sort of endorsed, as long as your process is properly executed. It's really about how you communicate it. Now, generally what we find, and this is based on more than 25 years of studies, when your unsophisticated participants pick their own investment options, they get poor results. They seldom ever achieve the returns that they should be achieving. And the reason is they tend to react poorly during times of violent change. Think back to where we were in February of this year when the markets got extremely volatile. Unsophisticated participants will frequently make changes to their investment lineup during those periods of time and not correct or adjust when things recover, or like what happened this year, they recovered so fast that you didn't have time to adjust. They're better off if we can put them in a professionally managed complete investment option, which is what your qualified default investment account should be. Now, I mentioned don't use just a default. You have to go through the process, and you have to take the steps to qualify that decision as a qualified default investment account.
Hey, Greg, I want to make sure that we have time for Lindsay. So if you can kind of
This one's going to be fast.
Awesome.
Thank you. Revenue sharing is something from the 90s. And if your plan is using it currently to pay cost, you should know that there's a lawsuit happening about once a week now in the large plan, the billion-dollar market, over this practice. Basically, the challenge is that it ties the fee that you're paying for the service to the investment behavior, the performance of the plan's assets. It's a bad idea. Many of the services that you receive in the plan could be structured as a flat fee or don't need to increase as plan assets go up. And the process there is just using explicit pricing to not use revenue sharing, go to lowest share class cost funds. Now, I want to thank everyone for listening to me today. Do we have time for any questions?
So, Greg, at this point, I got to move on to Lindsay.
That's
but
fine.
I'm sure if people have got questions, they can find you. I see
we can do it at the end.
Your email is right there at greg@echelonfg.com. So people can follow up with you directly.
Thank you.
Thank you. So at this time, I would like to bring in our third speaker. And Lindsay Connor is the Director of Brokerage for TMV Business Group. They're a full-service business broker and business advisory firm. So today she's going to talk to us about the importance of really knowing all of your options, because there's so many things you have to consider if you're thinking about maybe selling or exiting your business. So Lindsay, the floor is all yours. We look forward to what you have to share with us today.
All right. Thanks, Tom. Thanks very much. Good afternoon, everyone, and happy Friday. I don't know about you guys, but when I woke up this morning, I was pretty excited for some cooler weather. I'm from Chicago, and I'm ready for my first Texas summer to be over. I've been told multiple times that it wasn't a bad summer, so I'm a little scared to see what next summer has to offer. Again, my name is Lindsay Connor, and I'm the Director of Brokerage for TMV Business Group. TMV Business Group, we're a full-size a full-service business brokerage and business advisory firm specializing in small to mid-sized businesses and well-established lower market private entities. We service and assist businesses from growth to exit with focus on advisory to generate revenue growth, maximize profits, refinance, and finally help our clients secure an exit at top market value, which is the TMV and TMV Business Group. We don't just work with people looking to sell their companies or businesses. We also work and represent entrepreneurs looking to acquire businesses. So I'd like to start off today by asking everyone some questions to keep in mind during my presentation. You definitely don't have to have the answers right now. Just keep them in mind while I go through the presentation. First question, when would you like to sell or exit your business? And the next question, do you know your exit options when you sell? It doesn't matter if you just opened a business or you have owned and operated a company for many years. One thing is certain, you will exit your company one day in the future. So what types of exits are there? Let's talk about that. You could work in the business for the rest of your life until you die. You could semi-retire and let someone else run the business for the rest of your life. You could pass the business on to a family member. You could liquidate the assets of the business, either voluntarily or involuntarily. And finally, you could sell the business, which is the option that we're going to be talking about and focusing on this afternoon. I know the thought of selling your business can be overwhelming and intimidating. There are many concerns that arise, like I'm too young to sell my business, or my company is too young to sell. It's not ready yet. It's not the right time for me to sell. I'm not sure if I ever want to even sell my business. I don't know what I would do next if I sold my business. I don't think someone could continue the success that I have built if I were to sell my business. And finally, I don't know if I will be able to sell it for the price I believe my business is worth. And these are very common concerns that we get from a lot of our clients. This is why developing an exit strategy is one of the most important things you can do as a business owner. Whether you're ready to sell now, in the next few years, or many years down the road, a successful exit strategy is designed with your destination in mind. If you know where you're going, you can better understand where you are now and the steps you need to take to go in the right direction. The first and most important part of your exit strategy is your success team, a group of professionals to prepare and guide you through the sales process. A well-prepared business gets more offers. Key members of your team should include a CPA, accountant, and/or bookkeeper. They will help you and advise you on potential tax issues, maintain accurate and detailed financials, prepare your tax returns, and all very important documents which play an integral role in the company's valuation, which we'll talk about later, and the due diligence process, which we will also talk about later. You also want to have a good attorney. I know you need good attorneys for many different reasons, but you want a good business and labor attorney. They provide the legal documentation for the transaction and legal advice throughout the entire process, and they facilitate the closing process. You also want to have a business advisor, CFO, or fractional CFO on your team that you have a relationship with. This professional will help you identify areas to improve efficiency in the ways that you're operating your business to enhance a potential buyer's confidence. Some examples include cutting different costs, addressing employee turnover issues if you have any, the pricing that you're offering your customers, and payroll and payroll-related expenses. You also want to have a great wealth manager, someone like Stephanie on your team. Your wealth manager or financial advisor is a very crucial member of your team when you are thinking of selling your business and developing an exit plan. Many people may not think that their wealth manager is someone to include in the team, that their primary purpose is to manage their existing investments and give them guidance on their investment portfolios. However, a good wealth manager can add a lot more value. They will help you identify post-sale goals and financial needs to meet those goals. You know, whether you're retiring after you sell your business, you want to buy a new one, so you'll need funds for that, or you're changing career paths or just taking some time off. You definitely want to work with your wealth manager. They will make sure you're financially prepared to sell your business and also preserve and grow the wealth you acquire after you've sold your company. Staying along the financial lines, you also want to have a great business banker. They are another key member of the team. Seasoned business bankers have helped many clients through exits, so it's a process they're very familiar with and can offer you guidance. They're an integral part of helping your business with operational and lending needs, keeping the company going while it's up for sale, increasing loans or lines of credit to accommodate additional orders or operations expenses, and they may even actually be able to help your buyer with lending options as part of the purchase and the acquisition of your company. And finally, we will talk about one of the most important members of your team, your business broker. They are one of the most important members because they play a role throughout the entire transaction, from initial meeting to closing. They help you understand what your business is worth by providing you with a market valuation analysis. In the market valuation analysis is a very thorough and robust analysis of the industry, your industry, and previous comps and value and closed sales. And they provide that to you before you list your business. It helps them determine the market price and making sure you're comfortable with the number that they believe the market is telling you your business is worth. We also would help you prepare your business for sale, which allows the business owner to keep running their business through the entire sales process. Your success team would be managing the preparation for sale while you can continue to build value and pay attention to your clients and your team members. Brokers also identify and attract the right buyers. They know how to find the right buyer for you and for your business, and they also screen any potential buyers for you, so you only need to meet with qualified buyers that have met requirements. They also manage the due diligence process, which is one of the most important times in a transaction. It can take many months to get through due diligence. It includes setting up data rooms, which is an electronic file with all of your financials, any other essential information to your business that the buyer would need. They also work to maintain current financials, working with the rest of your success team and coordinating to make sure we're prepared for a successful close on the transaction. They also mediate discussions between the seller and the qualified buyer. And finally, your broker is your advocate and representative and will be with you every step of the way throughout the process and even after the process is over as well. So after hearing all of this, if you are thinking about my questions and you're not ready to sell yet, or you don't know if you're ready to sell, that's absolutely okay. You don't have to know right now, but you shouldn't wait until you are ready to sell your business in order to start assembling a great success team and thinking about an exit strategy. If you're on the fence, a good place to start is engaging with a good business broker that will provide you with a market valuation analysis to tell you where your company is right now. If it's not quite where you want it to be, then the brokers usually have a large network of business advisory professionals that we can refer you to in order to continue to build value in your company and get you to a point that you feel comfortable bringing it to market. So given that, I will leave you with one final thought. There's no perfect time to sell your business. There are always going to be factors outside of your control that you can think of that would impact your business. Take 2020, for example. I know I don't need to go into too much detail, but we've had COVID-19, we're in a volatile election year, and the markets have been turbulent. All things you can't control. But I can tell you from my experience, there are many buyers out there looking for acquisitions right now. So stay focused on your company and things within your control that can help you improve the value of your business and prepare you for a potential exit. Thank you. Tom, do we have any questions?
We do. So one of the questions that came in kind of through the private chat to me was around selling your business and concerns that people have. So what are some of the things, if someone, either themselves or they have a client who is thinking about selling, what are some of the common concerns they have? Like you touched on a couple where you said like, well, maybe I'm not ready. Maybe my business is too young. Mm-hmm. It's got to be an emotional thing to sell your business. So where does that come from with owners?
I think it comes from the passion and the hard work that business owners have put into building their business. We love working with local Austin business owners and seeing what they've created. And it's kind of like their baby. It's hard to let go of the baby or trust someone else to find the right person to kind of carry on their legacy. Mm-hmm. But that be that as it may, maybe no one wants to exit their business or have a plan to exit it. But like I said in the beginning, we're all going to change. We're all going to leave our business someday in one way or another. And it's to have a plan, even if it's a worst case scenario. But there's also other impacts. People may not want to sell their business, but they need to sell their business. And so we work with clients to get their business ready for sale. So I think that's the biggest concerns that we usually see with clients.
So do you ever run into a situation where it's the right time, someone knows they should sell, their kids don't want to take over, but they think, what am I going to do? I'm not 80 years old. What am I going to do after I sell my business? Do you counsel your clients on how to make that transition after they get the check?
Absolutely. So we work with, we have a large network. We work with our clients. We find out what their passions are. A lot of times our clients want to buy another business and try something new. So we obviously would have the ability to go out and find them a new company that would suit their needs. We would have a great relationship with them by then, so we know what they would be looking for. Or we can connect them with financial professionals to plan out their retirement if retirement is right for them. But we definitely do, that's part of our advisory servicing. We work with them to find out what is their next step.
So, and then one question that just came in was, how do you even determine the market value? I know you touched on it, but what else kind of goes into that?
There is a lot of work that goes into it. So we initially collect a lot of financial documentation, at least 3 years of P&Ls, balance sheets. We take a look at tax returns as well. We do a lot of research on the particular industry and what current economic conditions are having an impact on that industry. And we also have access to 10 plus years of historical comps for each industry. So we do a very thorough research. I think our reports are 15 to 20 pages long. And then we look at, is our business that we're looking at outperforming the market, or is it underperforming? And we can adjust, is it going to be at the top end of the market, towards the middle? And what's the demand right now for businesses like that? So there is quite a bit. It takes about 10 to 12 days to put that together.
So flipping this to the other side, because someone might share this in the replay with someone who wants to buy a business. So if you want to buy a business and you're not sitting on tens of thousands, hundreds of thousands, millions of dollars, is that something you can do? How would one go about buying a business if they weren't already rich and sitting on money?
Yeah, well, there's a lot of ways you can do that. We get contacted by entrepreneurs quite a bit. They may see a listing of ours online and that may not be right for them, but they know that we are a business broker and we can go out and find something. So what we do first is set up an initial meeting with them to find out, what you don't have to buy a business with cash. There's lots of financing options. There's SBA, there's conventional financing, and sometimes you can even negotiate the seller to do a seller's note to supplement the transaction to get you where you need to be. But we help them determine what their range is that they could use to purchase a company, and find out what they think they would be successful at and what their goals and objectives are in having a company, whether it's some passive income or they want to jump in and run the business themselves. We can find them something.
It's been a trying year for a lot of people. I know, in one of my businesses, I watched it go from really big to zero just because the meetings business dried up. And I thought, maybe I should just go buy a business in another industry. Maybe you and I need to talk.
Yeah, that sounds great.
Well, if Stephanie and Greg will rejoin us with their cameras back on, I want to thank all of you for participating in this BAP webinar. I greatly appreciate all of the information that you shared with our audience. We had a lot of people here live attending, watching this go, and then we also have the rebroadcast. So as we sort of sign off, the title of our deal was 3 ways to move forward in a challenging business environment. But the reality is there's probably thousands of ways that we all have to intake to move forward through challenging times. One last piece of business advice, it could be directly to what you talked about, or it could be something else that you want to share. What would you share with our audience of how do we move forward through the rest of this pandemic? Greg, why don't you go first?
I would just try and focus on moving the plan for what's next. You can't fix where we're at, but you can prepare yourself for the next problem that comes up. By doing the right things now, not making the mistakes, you'll be much better off in the future.
Good planning always helps, and there's always going to be another problem down the road. So I think
Exactly.
that's great advice. Lindsay, how about you?
So I think the most valuable piece of information I want to leave everyone with is know your options when the unexpected arises, because I think, everyone is always hypothetically planning for an inevitable event that will change the way they do their business or their lives. But I think 2020 has proven that those events can happen, and some of them have this year. And a lot of business owners have gone out of business. People have lost their jobs. So always be thinking down the road and looking forward looking, so you can quickly pivot when things go awry.
Yes, because they always will.
Yes.
Stephanie, your thoughts?
Well, I think we all know that we should always be aware of what we own and how we're using and what our resources are. But the realities of life, being busy, we're not always able to take the time to do that. So my advice would be, if things are a bit slow right now, unfortunately in business, and there's nothing that you can do to kickstart it right now, maybe see it as an opportunity then to go back and reevaluate the things that you do have in place. Maybe checking on the aspects that you hadn't been devoting time to that you should have.
Awesome. And I think I'll leave everybody with one little piece of advice, even though nobody asked me. And that is, I wrote a book several years ago that sold like 25,000 copies on basically how to make, grow, and keep your business relationships. It was a book on networking. And over the 20 years or 18 years since I wrote it, a lot of things have changed. And yet some things have remained the same. The reality is that all opportunities in life come from people. And so we cannot forget, during this time that we're socially distanced, we need to make sure that we're being proactive to socially tighten, which means getting around smart people. It's participating in groups like we do with the business advisory professionals, those of us who belong to BAP. It's tuning in on webinars, because while we can't be face-to-face, you can gain that knowledge from people by participating like you did today in this. And then one thing that I did starting back in early April is I made it a promise to myself that throughout COVID and the quarantine, that 3 weeks it was going to last. We were going to be locked down for 3 weeks, 5 max. I made a promise that every single day I was going to reach out and talk to somebody who was smart and just ask them for advice. And I've done that almost daily now for 7 months. And I can't say everybody had great advice, but I probably wouldn't be here today if it wasn't for a couple of people having some life-changing advice. So remember, all opportunities come from people. Don't lose touch with the important people in your life, in your career, in your community, in your faith community, in your family, etc. So thank you very much for participating in today's webinar from the Business Advisory Professionals. Check us out at businessadvisoryprofessionals.com. If you're looking for any type of service in Austin, if we don't have a member who does it, one of us knows somebody who does it and does it really well. So reach out to the BAP group for any service that you might need. Thank you so much for participating. We really appreciate you, and we will be doing more of these BAPinars going forward. All right, everybody. Thanks a lot. Have a great day.
Thanks, everyone.
Bye.